Good morning, everyone. Welcome to the Macro Snapshot. We are Tuesday, June the 24th, 2025, recording this about 7:30 in the morning. Okay, so let's start with oil. Obviously, a lot of movement over the last 24 hours in oil. First of all, if we look at oil volatility, we can see that it's collapsed. It was at a very, very elevated level at 75. As you can obviously see here on this daily chart, down significantly. So oil collapsing, and that's just basically on the back of the so-called well, two things really. First of all, most recently, it seems to be sort of a truce has come into effect between Iran and Israel. There's been some sort of contraventions of it on both sides, but more or less that seems to be holding. But really what happened is that yesterday Iran launched their sort of retaliation on some US air bases in Kuwait and primarily in Qatar. But apparently they gave forward advance of that, pre-notice of that. There were no casualties, not so much damage. So essentially, this was like a bit of political theater. And we mentioned that this goes back to the way they operate. If you go back to the beginning of 2020, when the American sort of administration sort of assassinated one of the main commanders in Iran, Soleimani, and again, Iran reacted in a way which was, relatively symbolic and theatrical, essentially saying to the world and maybe to their own people and maybe other people in the Middle East, other countries in the Middle East, look, we fired some missiles, but actually we didn't want to sort of escalate. So the point is, de-escalation is on the board. And if we actually just look at the oil price, had a very, very major collapse as soon as it became sort of apparent that this sort of retaliation by Iran is a bit more sort of on the symbolic and theatrical side rather than attempting to escalate. So this is where we're at. So we're at about $78, and as you can see here on this daily chart for the front contract of CL1, we're down about $12. So a huge fall, 1,200 ticks, but finding a little bit of a support here, I guess at around about this 66 level. And if you go back, this is some quite long-term support. This line goes all the way back here. So that's where we're at now. And so basically now the market is probably obviously going to be keeping an eye on the Middle East. But at this point, the reality is that the Straits of Hormuz were not blocked. There was no disruption to oil flows. So at this point, we have an economy globally which is doing reasonably well. But it's not really accelerating. There's still the tariff threat, and there's still extra production happening from OPEC plus, and there's still a bit of an oil surplus. That's the situation. So it's almost as though we go back to where we were, sort of a few weeks ago, and we restart. And you can see this just how this has been reflected. Just a couple of other charts. Again, sorry, my Zoom and everything seems to be sticky here, or actually, I think it's my computer. I don't know what's going on. So let's just have a look here. Again, this is the CL1. This is the crude oil sort of the calendar spread, just the curve here. And you can see here that it's still quite nicely in backwardation. But if we compare this to yesterday, a really very, very steep fall off. Let's just let it sort of load up here. And you can see here that the curve, has kept about the same shape, but we've gone from a much, much higher price down. So you see here, actually that's saying yesterday's price. So maybe we won't actually, I don't know, put on a week ago. You can just get a sense of here just how much we've come down. So obviously that's come down a lot, but the front of the curve is still in sort of backwardation. Although having said that, if we start looking at a couple of other things, let's now just look at the call put skew sort of situation here, and you can see here that this has collapsed. Normally this is negative, it's a little bit more biased down towards the puts, but you can see here that's spiked. Obviously this is a 30-minute chart. You can see it's spiked up to a premium of about 16 or 17 points, and we're now down to just between 1 and 2. So you can see on that as well, just showing that the necessity for upside calls has diminished dramatically in the last 24 hours. And then finally, let's look at a spread which a lot of big players use and look at, which is the December, so December 05, December 26. And you can see here again on a 30-minute chart, you can see how that spiked up to about $3.50 over the last 4 or 5 days, and then just dramatically falling off yesterday as it became apparent that as I said, the retaliation by Iran was more on the symbolic sense. So that's where we're at. So oil at this point has come off. The price has come down. Now that has some interesting effects. Firstly, on currencies, for example, like the Japanese yen. which we'll get to in a second, which, something which is a huge oil importer. That's put a little less pressure on the Japanese yen. It's also in terms of inflation expectations. Remember that if oil spikes, that tends to push up inflation expectations. It's not great for the long end of the US bond curve as well. So that's interesting that inflation expectations should go down in theory if oil just remains at this sort of lower level. I'm just going to grab some tea. So the second thing yesterday, which was very interesting from my point of view, was just what's going on with the Fed. Now, this morning at 10 o'clock, we have Jerome Powell's semi-annual sort of testimony in front of the Congress. Tomorrow it's in front of the Senate. Today, starting from 10 o'clock, he's in front of the House. And that's going to be quite interesting. First of all, keep in mind that sometimes the prepared remarks, those headlines are released, although he sort of physically starts to be present at 10 o'clock. Often his remarks are released a little bit before, maybe 5 to 10 or 9:58, something like that. So let's listen out for those. But what's been going on is that Trump has been absolutely sort of extraordinary. It's quite extraordinary for someone like me who's been watching this for a long time. Just look at what Trump's been saying. And even as recently as this morning on a tweet, you can see just like sort of public insults. I mean, it's quite extraordinary. Too late, Jerome Powell of the Fed will be in Congress today in order to explain, amongst other things, why he's refusing to lower the rate. So we know that Trump is pushing, insulting, cajoling Powell to sort of cut interest rates. He's saying Europe has had 10. I think it's actually 8. We've had 0. He wants, in his mind, less sort of a lower interest rate is going to save money on the interest rate bill for the US. He's saying $800 billion a year, et cetera, et cetera. But look at this. I hope Congress really works this very dumb, hard-headed person over. I mean, quite apart from the horrible English and lack of grammar, just extraordinary sort of public attack on an official and on an institution which in theory is sort of independent. And keep in mind that the Supreme Court relatively recently in a sort of allied kind of case basically said that these kind of government sort of agencies actually people can't be fired and they do have legal independence. So it's quite extraordinary that Trump feels emboldened enough for these public attacks. We will be paying for his incompetence for many years to come. The board should activate. Now, this is actually very interesting because obviously what Trump wants is for Powell to sort of cut the interest rates. And what we've seen is that over the last 3 or 4, 5, 6 FOMC meetings, the board, so the board of governors and the FOMC board itself has not cut interest rates, as we know, and they've been fairly unanimous and fairly solid. But what's quite interesting is that over the last, I would say, 72 hours, we're starting to see a little bit of fracture in that sort of common front. And we had Waller on Friday basically saying that, possibly July could be a live meeting as long as inflation didn't sort of accelerate again. We also had sort of Michelle Bowman yesterday, who's on the board of governors, and both of these are Trump appointees, keep in mind, saying that more or less the same message, saying that, as the economy was strong, as long as inflation didn't sort of rear its ugly head too much, maybe they should be cutting again. We also had Goolsbee yesterday, who was not as dovish, but saying, well, maybe we should sort of look at the situation. So the point I'm trying to make here is that there are definitely a few members of the FOMC and who are maybe even angling for the top job once Powell's term sort of finishes. But what we saw here, which is quite interesting, is the market really is taking attention and thinking that maybe something's going on. So we see here that for the July meeting, where there was a 0 chance of a cut, we can see now there's actually 22% chance. So only 5 basis points, but that's gone from 0 to 5. And then if you look at something like the end of December, which, as you know, I like to look at, that's now got over 2.3 cuts. So over 2 cuts, we're now at 57 basis points. So if you actually look here, some of this, you can see here the repricing. This is the tick chart, so the very short-term intraday. But you can see here yesterday, as some of those comments were released from sort of Michelle Bowman, you can see here that the market is taking attention. And it's actually starting to think that maybe there's so much pressure on Powell, and maybe even his view himself is that, the inflation from the tariffs won't be as bad. And then it's time to maybe start thinking about restarting the cutting cycle. So as you can see, we've come back a little bit more hawkish over the last couple of hours or so, but still. were well above, almost down to, we got down to 60 basis points by the end of the year. And that had been, if we just sort of scroll back here, I don't know how far back we can go, that had got down to about 45 basis points. You see actually here about 42 basis points as recently as, you know, sort of 6, 7, 8, 9 days ago. So definitely there's a lot of pressure on. It's going to be extremely interesting today to see if Powell gives a little bit and is a little bit dovish. That's going to be dovish for bonds. It's going to be actually the front end of the curve. Keep in mind that the long end of the curve will probably not like that. We'll get to that in a second. So it's good, as I say, it's going to be very interesting today to see whether Powell repeats his message from last Wednesday after the Fed meeting and basically says that you know, there's no reason to cut rates at the moment. They need more clarity. They need more data. The employment situation is still strong. The economy is strong. There's no necessity at this point to cut rates, given the uncertainty about the push through potentially of tariffs, tariff-based inflation. We shall see. On the other hand, let's have a look and see if Powell actually, you know, does give a little bit of a dovish hint. Keep in mind as well that the fact that oil price has gone down a lot, that's something which could give him a little bit of cover to say that, you know, that's one cause of potential inflation, which has sort of diminished a little bit. So where we're seeing this as well, let's just look at a couple of charts. We're seeing, let's just go back. Okay, so let's just go through some of the basic charts here. We're seeing that obviously the VIX has come down a little bit just as those geopolitical tensions seem to be coming off the boil. The S&P, again, pushing, as we can all see here on the daily chart, the mini EE futures, like the path of least resistance here is to push towards a high. At this point, there's nothing sort of bearish about this chart. Maybe you could argue it's losing a little bit of momentum, but we've got a big up green candle yesterday, pushing higher. Maybe lower interest rates, less geopolitical tension. Maybe the tariffs are going to sort of grind their way to a lower level. Same thing in NASDAQ. But if we look at some of the other charts here, I just want to draw your attention, let's say, to the bond market. And you can see here that the bond market, this is the front end of the curve, so the ZT. You can see here that the two-year bonds are particularly liking this talk about the Fed potentially being a little bit more dovish. And you can see they're sort of grinding a little bit higher. Keep in mind, though, not such great news for the back end of the curve. You can see here the ZB, not nearly as much. So we've had a little bit of a steepening here. So if we actually look at just the curve, if we look at the 2s30s, for example, there we go, the 2s30s, you can see the curve is starting to steepen here. And one of the reasons for that is that, first of all, the economy is doing quite well. But secondly, the point is that if the Fed were to be a little less dovish and maybe even start their cutting cycle in maybe not July, but let's say the following meeting, that means less you know, tough medicine for inflation, which ordinarily is not great news for the long end of the curve. Remember, the long end of the curve likes a Fed which is, you know, keeping inflation under control. So it's interesting that sort of steepening is happening. And again, you see here, just to look at it again, you see on the yields, the two-year yield coming down, you know, quite solidly. Whereas if we look at the 30-year yield, essentially more or less unchanged since yesterday, coming down, but not nearly as dramatically as the 2-year yield. We could also see here a little bit of a steepening here over in Germany. This is the 2s30s. If we look at the 2s10s, we're also getting a little bit of a steepening here. And part of that, it could be in sympathy with the what's happening in the US, but also maybe a little less geopolitical risk in Europe and the Middle East. So possibly, you know, everyone's now refocusing on the macro. And what we basically have is at the front of the curve, we have the European Union. If we look at the let's say the German 2-year, you could see the German 2-year not really doing much. The ECB has cut quite a lot. They've basically signaled that, you know, maybe they'll cut, maybe they won't, but there's not a lot to do in the short term. They've done a lot of the hard work. So the 2-year pretty anchored here. Whereas if we look at something like the 30-year, the Buchsel, you can see that's pushing a lot higher. And even the Bund is pushing a little bit higher and potentially breaking out of this downtrend here. And that's also on the back that we're starting to get some sense of the budget. There were some numbers released yesterday in Germany, essentially saying that there could be extra issuance or more issuance of longer term yields, so 10 and 30-year bonds. more issuance on those sort of as we go through 2025 into 2026. And so the long end of the German curve not liking this information that there could be more sort of deficits, more sort of spending, more infrastructure spending, more defense spending, which requires more bonds, of course, to be issued. And just finally, guys, want to have a look at over in FX space. Interesting that with that risk premium going out of the Middle East, we see the dollar index here falling quite hard. And it's just interesting here that you see this downtrend. It couldn't actually, it just sort of poked its head above, basically being rejected. And to be honest, this downtrend continues. And although there had been some sort of little bounces here, you can see that it's actually found it very hard to break out of this downtrend. But at no point have we been above the 50-day moving average since, well, essentially going all the way back to the beginning of March. So the US dollar does seem to be regaining its downtrend. And one thing which I want to talk about is that one of the cornerstones of strength of the US Treasury market and the US dollar historically has been the fact that the Federal Reserve is independent. It conducts independent monetary policy, independent and free from political interference. Trump is pushing these boundaries like no one has done for a long, long time, maybe even going back to Nixon back in the 70s. The last one I can remember who was, as aggressive, but even Nixon was nothing like Trump. I mean, sort of publicly insulting him and whatnot. Just this is a bit of a bigger issue, but it could be that also global markets are looking at the US and saying, is the Fed slowly losing its independence, which is not great for the US dollar as the world's reserve currency, and it's not great in another sense for the sanctity of US bonds. So let's keep an eye on that. And that, again, will be bad for the long end of the curve. So anyway, so the dollar index coming down, we can see that just looking at the reaction, euro having a fairly positive sort of pushing up towards its recent highs again. You can see it's up to about 116. No reason to believe. I mean, it's going to depend on Trump, on Powell and the tariffs and data and whatnot. But if Powell gives even the tiniest hint that is maybe a little more amenable to cuts, for sure, US dollar could lose. We could see the euro sort of pushing a little bit higher. We also see USD Swiss franc going down against the pound. We see the pound having a big push up here. So US dollar broadly weak. Again, also the Japanese yen. Here we go. Is this time for the yen to shine again? So you see the yen or the US dollar actually sort of peaking out here. And as I was mentioning yesterday, that recent high and the 200-day moving average couldn't actually gain any of those and pushing down. So let's see what happens now. Does the US dollar weaken further? It's got the next resistance. It's going to be at this sort of uptrend here. Let's see if it pushes there, and who knows, could even test all the way down. In terms of CAD, interesting that we do have Canadian CPI, so the inflation numbers coming up in about an hour at 8:30 or so. You see the US dollar sort of falling again, a little bit weakening a little bit again against the Canadian dollar. The Bank of Canada basically said that the economy is still quite fragile, but they are a little bit concerned about inflation. So it's going to be interesting at 8:30 to look at the Canadian inflation numbers and see whether that gives or doesn't give any justification for the Bank of Canada to continue cutting or to remain on pause. And finally, if you just look at the Antipodeans, you see the Aussie up quite strongly. You see also New Zealand Kiwi up quite strongly. So broad US dollar weakness, which is probably going to be good for things like emerging markets and obviously some of these other currencies like the South African rand or the Brazilian real, things like this. Okay, guys, I'll leave it there. As I say, apart from the Canadian data, let's keep an eye on headlines from the Middle East. But probably most importantly is going to be to see the politics of how the Congress sort of deals with Powell today, and also whether he gives any ground and gives any sense that he's more open to potentially starting the cutting cycle again. That's going to have ramifications for the bond market, the US dollar, and of course, equities would love any further dovishness. Thank you very much. Have a great day, and let's keep the conversation going. Thank you.